RWA, real-world asset, is a completely nonsense and useless term because it mixes up way too many things. What is a real-world asset? So this is why I'm really upset that this real-world asset thing has taken off, because you need a Merkle tree, but you don't always need a blockchain. You really have to distinguish between what is going on in capital markets and the thinking that I see in capital markets and kind of the degen world. So stuff is moving, and what is moving obviously is collateralization of cash and cash equivalents. And why is this so important? Because in the end, it's about capital efficiency, right? Tokenization is about capital efficiency. I can prove that I have something that is possibly worth something, which is in the eye of the beholder, but then I can collateralize that, and that is getting me access to capital more efficiently. That's what this is about.
Ralf Kubli led M&A and B2B ventures across industries before diving into AI and blockchain. An eye-opening fintech investment drew him to Switzerland's Crypto Valley in 2017,
where he now drives the decentralized future as an investor, advisor, and board member.
So we need to solve this credit problem in emerging economies and developing economies. You have to imagine in some developing countries, the only tradable debt is the government debt. So you cannot securitize anything else but the government's debt, if at all. That's terrible. We need to find a way to have natively digital credit obligations that can live as objects on these new rails, which then can be securitized and really bring liquidity to these markets. So that's the promise of the technology. This is why we have to be excited, whether you're a maxi or not, but this is the reason why you have to be excited about this technology.
Hey guys, welcome back to Less Noise, More Signal. Yet another episode. Looking forward to this one. I have Ralf Kubli with me. Ralf, I originally met you, I guess, somewhere in Switzerland, as we're both from Switzerland, and we've seen us here and there at some sort of events, but you've always struck me as somebody who has like interesting and spicy takes, especially on the topic of tokenization as well, and that's why I wanted to bring you on. So happy to have you here.
Thank you. Thanks, Pascal, for having me. It's a pleasure.
Nice, Ralf. So cool. If you could maybe quickly introduce yourself, how have you come across crypto, blockchain, Bitcoin tokenization, and then also what are you currently doing in this space? That would be great to know.
Great, thanks. Yeah, I've always kind of dabbled in technology. Like in the early 90s, I got my first email, and then I coded HTML like in the mid 90s. And it was quite exciting. Then I spent a lot of time in large industrial firms where I spent less time on technology. And then in 2015, I came across Ethereum and really started to understand what it meant in terms of also enterprise environments and for us as citizens. And I got very excited and made some first investments. And then 2017, I really wanted to join the space, which I did. Then I joined the Crypto Valley Venture Capital, CVVC, which is one of the key infrastructure providers, so to speak, with co-working space and investments in Crypto Valley. And now what I'm doing today is I joined a few boards and help firms develop themselves. I was on the board of a layer 1 blockchain, and today I'm on two boards actually. One firm called Validation Cloud, which is providing infrastructure for the Web3 space, those taking node APIs and data and AI, and as well as Ariadne, which is a financial technology firm.
Okay, I see. Interesting. And I think you're still quite close, as we can hear, to the entire tokenization spectrum and world and sphere, or whatever we want to call it. And maybe I think to start off, it would be interesting to sort of disentangle this entire word salad, that we sort of have nowadays when it comes to RWAs, tokenization, all these different buzzwords. And I think a lot of people do understand a lot of different things when it comes to these terms. So maybe where do you want to start? I think like sort of disentangling this would be good.
Yeah, I think the really big question is what problem does it solve, and I think there's a few aspects here to consider. So first, maybe I'd like to speak about what I think tokenization is, And then I think it's important to think about what are we tokenizing, right? What is it that then is represented in tokens? And then from that, we can discuss what problem does it solve and why it's so exciting. So first, when you think about tokenization, I think Bitcoin here is instructive, right? Bitcoin is a true bearer instrument. That's the ultimate form of tokenization, right? I hold the token. No one can take it from me, unless they get the private key from me. It's run independently. So this is a super exciting concept, right? Because all economic activity is built on basically property rights. So this is really exciting. So this means that I would call tokenization basically in short form is allows you to cryptographically secure an asset, anything. And in the case of Bitcoin, it is a cryptocurrency. In the case of other things, it's going to be something else, right? So that would lead us to what are we really tokenizing? And as you mentioned, I think it's important to think about this in categories that we already know. And here, of course, we're a little bit a victim of an industry that creates its own terminology always, in order to kind of like veil, the simplicity maybe of the approach, and also venture capitalists, right? Venture capitalists need to create new stuff so they can raise money against it. And I'm writing quite a bit about it. I've lost the fight very early on. I said RWA, real world asset, is a completely nonsense and useless term, because it mixes up way too many things, right? What is a real world asset? I mean, a treasury, a German, a US treasury bill or note, or a German Bund. I mean, we're not holding this physically, so it's not real. It's digital already. So what is real? Nothing is real about that, right? So it makes no sense.
Even in terms of Bitcoin, maybe some people would argue to them it's very real. It's the realest asset that has ever existed. Because exactly as you described, you can hold it yourself. It's in terms of property rights, you're not beholden to anyone else to actually own it. And or hold it at least. And so what some would even argue, Bitcoin is a real world asset in that sense, but not as it is
purely digital. It's purely digital. It doesn't exist in any other form than digital form. So, and then maybe one more aspect here. So when I have a baseball card, or in Europe we know the Panini cards, from soccer players, right, during the World Cups and Euro Cups. I mean, these are real, right? I have the card in my hand, and now I tokenize it, right? And now, is that then a real asset if the token is, represents this Panini card? I don't know. I mean, it's a good question. And the other aspect is when you think about games, right? Probably many of your listeners are gamers. When you think about gaming, and you have shields, or skins or whatever in games, I mean, these are assets, but they're not real at all, right? But is this, when I tokenize it now, is it real? No, it's not. So this is why I'm really upset that this real world asset thing has taken off, because I think you have to think about it in well-defined terminologies that most people understand, which is balance sheets, right? We have to think about what lives on balance sheets. And, we all have balance sheets. So we as individuals have balance sheets, companies have balance sheets, governments have balance sheets. So I think it's important to understand what we're tokenizing in the context of balance sheets. And on balance sheets, there are financial assets and liabilities, of course. There are tangible assets and there are intangible assets that live on our balance sheet. And I promise you, and I will pay a beer or whatever, we can exchange Satoshis or something. Anything that anyone claims is a real world asset can be properly defined between a balance sheet, what lives on a balance sheet, so a financial asset, a tangible asset, or an intangible asset, right? Which also would clean up this mess on people talking about real estate tokenization, right? Because most people do not tokenize the house. You can't tokenize the house. You just can't. You cannot transform the house in a token. You either represents their property right, in the deed, etc., to the house, or you tokenize an SPV that represents the ownership of the house, right? Which is what most people do. So that's why this is so upsetting. And when you think in these categories, financial assets, tangible assets, and intangible assets, it becomes very clear what we can tokenize, right? When you think about what a company has on its balance sheet, that's financial assets. It has intangible assets like intellectual property rights, brands, etc., trade secrets, and there's tangible assets, inventory, for example, semi-finished goods inventory, etc., right? So, and then once you start to think about what this means is that some of the assets that live on our balance sheets, like intangible assets and financial assets, are purely digital already. Which is why tokenization is so important, because we can now tokenize relatively easily, these digital, these assets already live in digital form on these balance sheets. So then you can tokenize these assets.
Yeah, exactly. That's well described, and I think that leads to some of the follow-up questions that I have, because you described it well. In terms of Bitcoin, it's a digital token. And once you transfer the digital token, like the actual value and everything that's associated with it is transferred as well. As instead of the house that you described, there obviously, if you have a token representing sort of a house, the house is still physical. It's somewhere in the real world. If you transfer the token, the house doesn't automatically move or sort of in the real world. And that's where some of the Bitcoin people like rightfully also have like these questions. Okay, then, but wasn't tokenization sort of made for Bitcoin, and maybe if there's other digital assets, but not like for the real world stuff? And because like whenever you have something real, then you have to sort of appeal to another entity. In terms of, again, with the house, it's probably somebody who, because you're transferring the property rights, as you said, you need some type of lawyers maybe involved. And even with financial assets, it's again, there is like, maybe even if it's not real anymore, but still there's a company involved. And that's why the question maybe is it that a misnomer in the beginning, tokenization, because it's only made for a few things and we're enlarging it, and maybe there's no use case for these things after all? But you may be arguing, well, no, it's not that easy, right? There are use cases. This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
So I think, and we should revisit that subject. The question of degen, like a complete, how can I say that? A complete separation, right, of like a Bitcoin-based economy from all institutions, that you can solve everything with blockchain and this immutable ledger. I think that is, that is great if people want to pursue that. I'm not against it, right? So I'm not against maxis at all. I don't dismiss maxis, but or maxis in the sense of, you can build an entirely new economic system just on Bitcoin and with blockchain technology. You still need institutions in the end that you can enforce your rights, that guarantee certain rights, etc. You still need courts to adjudicate, hopefully. Not everything can be done in a digital form, but still that doesn't reduce the excitement for tokenization, because just as I just said, imagine what it means for the world. And by the way, gaining gaming has showed us what it can mean, right? There are entire economies, there are entire communities running on these in this gaming environment. The problem, of course, is it's the centralized, entity of the gaming company that basically, rules that world in a dictatorial manner, right? They make up the rules. You cannot, there's nothing you can contribute as a gamer, to that environment. But still, it shows how important and how exciting it is to live in a purely digital asset-based world, right? And that is the power of this technology. So maybe we can briefly talk about what I believe the problems that it solves now, right? So now you have this concept of an immutable ledger, which allows you to cryptographically secure an asset, and of course, the more digital the asset is, natively digital the asset is, the easier it is then to secure this asset. And that's a phenomenal concept, because when you think about what we have also as individuals, but firms on our balance sheet, a lot of that is intangible or intangible assets. Now, in the context of music, people understand it, right? And it's kind of frustrating that it hasn't been solved yet. But in the concept of music can be purely digital, right? It's purely digital. And you can then claim your rights against this music. So if you composed something, or if you played one specific instrument, in a track, that is extremely popular, you should be able to earn the royalties that come against this, right? And the economic benefit come against this in a very easy way, because it's all digital already. So I think that's the frustration of people, that they think like nothing is moving, but it actually is moving, right? So we have people that understand, if something exists in digital form, natively digital form, we can build much better systems with or without blockchains, but, preferably with blockchains or, cryptographically secured ownership rights that then let, the contributors to these systems benefit, from the things that they have created and that they have given and that they have invented and so on, right? So that's amazing. That in itself is amazing. And what problem does this solve? It solves the problem of collateralization, right? Once I have this secured, which is why Bitcoin is so amazing, but in non-Bitcoin denominated world, right, where I have a piece of music, when I can prove that this is really mine, I can collateralize against this, right? So I can go and borrow against it, right? I can borrow against the future cash flow streams that this asset has. This is why tokenization is so important. And when we spoke, right, Pascal, you said, well, we're stuck, right? So people say, nothing is moving and it's frustrating. So what do you think about that? What is your...
Yeah, I see. No, I mean, you're right. You explained it well in terms of with the collateral aspect, and that's also one of the reasons that I'm fascinated about the entire topic, in terms of like real world assets, again, I'm using this term, but if we have sort of silver, or gold or any sort of other commodity, that's maybe sitting on a company's balance sheet, and it's kind of hard to go to a bank and try to take a loan out against it, because the bank doesn't know, is it really there? Is it gonna how to sort of value it? They have nothing to touch. And maybe if there was a token with clear cut rights attached to it and stuff, they would be more willing to maybe lend against it, and then you could use it as a collateral. So this, or you could even then go again to some other non-bank entity, now maybe a DeFi protocol, I don't know, like then sort of collateralize it and get your loan out of this. But the thing that I'm wondering is, in terms of the music and everything that you explained, or as well, I'm wondering, why hasn't it happened then yet? Is it maybe because there's no economic case, but maybe people don't want this, maybe a music video isn't that good of a collateral, like economically speaking, after all, or what's the case? Why hasn't it happened yet? Because sort of in theory, it makes sense to me as well. So what are your thoughts there?
Okay, so there's a few aspects. I think you really have to think about native digitization, right? What is native digital already and can be used like right away, right, in these environments? So that's one. And then the other thing is, of course, how difficult is it? What is the market structure today? How many people do I have to convince that now we have this new thing on a new rail, or in a new environment, and it's really the thing, and you can borrow and lend against it. So that is, of course, difficult. And it's not easy, right? I mean, these big transformations don't go fast. Remember, I mean, I don't know how many people on this podcast remember, but I do, right? I stopped designing websites in 98 or something like this, because I thought, at some point this will, it will be over, but it's not, right? I mean, these big technology transformations, they take a little while, right? So let me be a bit more optimistic. And I think also for the audience here, you really have to distinguish between what is going on in capital markets and the thinking that I see in capital markets, and kind of the degen world, right? What can be done independently, and how can we get rid of these evil institutions and so on. So I think these are two things for me. So one is, it's moving in finance and capital markets, right? I mean, it is very clear that some of the largest players in this industry, in the finance industry, have recognized that the shared ledger is extremely powerful, and the cryptographically secured ledger, shared ledger, is even more powerful, right? And that's what they're building, new infrastructure for. And what do they start first with, which I think is great. And here I have to do a shout out to UBS in Switzerland. I think people do not realize that there's a project called Finality, F-N-A-L-I-T-Y, Finality. That was started in UBS. Now, I don't remember when exactly, 2012, 13, 14, something like this. Why was it started? Because UBS has a lot of industrial clients, there's a lot of companies, and they need to net their books all the time, right? These related entities owe each other money. And that's why UBS started this project, because they knew that a shared ledger where they can move things around, is extremely powerful. This is why JP Morgan coin was conceived of, right? So JP Morgan, as one of the largest netting companies in the world, understood that once we have a token, even if it's inside only our firm and between our clients, we can net out these accounts a lot easier, right? Rather than using existing ones. So stuff is moving, and what is moving obviously is collateralization of cash and cash equivalents, right? And why is this so important? Because, it's not necessarily cost. So people say, yeah, it's much cheaper to do repo on blockchain and so on. I'm not sure whether it's really cost. I think it's the programmability and the efficiency in terms of the contracts that can be written, right? So now you can collateralize certain assets, cash and cash equivalents, right? And what do I mean by cash and cash equivalents? Real cash that sits on a bank account, or USDC could also be, that's also cash equivalent, the stable coin, or treasuries, or German government bonds. This is and Swiss government bonds. This is cash equivalent, right? So you can basically say, I give you this for the next 36 minutes, or for the next 36 hours and 15 minutes. That was very difficult to do in the current environment. So that is moving, right? So that's one aspect, and this is going, and I think it's clear people build infrastructure. And the other one is funds tokenization, right? Everybody says, yeah, funds. When you in Switzerland and in Europe, we probably know about Luxembourg. If ever anybody has been to Luxembourg and sees all these office parks in Luxembourg, I mean, this is nonsense. I mean, all they do is administer funds. I mean, it's crazy. So you can do this with technology, and this will be done with technology. So, I mean, there will be a lot of empty office spaces in a lot of financial centers that do nothing else but reconcile ledgers, and this will be solved with this technology.
And that's actually good about Luxembourg. Yeah, because I do work at a bank as well, and whenever we sort of look at starting new funds or certificates or something like this, yeah, you always have to turn to Luxembourg and see that there's, as you said, they're just institutions just doing this, and this could probably disintermediated, as we usually say. But I mean, one thing, thanks for explaining this to us. I mean, one thing that also comes to mind is obviously BlackRock, because like I feel like with BlackRock, when I look at them in terms of crypto and digital assets, and I'm trying to dissect the signal. What's really interesting to me in terms of crypto assets, they've only filed for a Bitcoin ETFs and the Ethereum ETF so far, nothing else, And so that's also where I sort of see the signal, that they're not going for any other cryptocurrencies. It's just like the big two, so to say. And so for me, BlackRock, whenever they do something, they are sort of a high signal company, where they're going. That's probably where the puck is going to. And that's why, and it's probably where I try to take up the cudgels for tokenization, in front of all my Bitcoiner friends, because I think BlackRock is seriously looking at tokenization, and they've done stuff like the fund tokenization. I think it's a money market fund that they tokenized and stuff. So I feel there, maybe you can go into detail there as well, and maybe sort of explain what they're doing and why it's a benefit to them and maybe to the ecosystem. And they're even using a public blockchain then again, so it's not one of these sort of siloed systems. So I feel like there must be some signal, even though I have a hard time really dissecting where it is, but maybe you can help us.
Yeah, I think, look, the way that I look at it is there's this kind of like these three worlds, right? One is public, including like DeFi primitives and so on, and traditional, instruments on a public environment. Then there's this discussion always of private and permissioned environments. And then I think, there are applications, that need to find their ways, right? And institutions that need to find their ways. And for me, maybe we can talk about quickly about this public and permissioned environments, right? So it is clear that the shared ledger is very powerful. It solves reconciliation problems. And you have some examples not many people know, but for example, there's an infrastructure in Italy, and I will not say on what it is run because I'm not 100% sure, but there's an infrastructure in Italy where the Italian banks net out the liabilities against each other every day. So I mean, you have to imagine that, right? The entirety of Italian banks, right, net out their liabilities on this infrastructure every day. Now, it's clear they don't want to do that on an Ethereum, blockchain, right? So that seems to be quite logical. But of course, it takes a long time for something like this to be kicked off and to be done, right? Because, that's a big transformation process. But still, so this exists. And BlackRock is a great example, but I think in Europe we have another example, which is Börse Stuttgart, for example, which has committed publicly to only build on public chains. Right. They are convinced that the future is public. And I think BlackRock is an interesting signal as well. Why? Look, there will be certain critical infrastructure that banks will build on and build on DLT technology, right, on distributed ledger technology internally. And this is very powerful. In Switzerland, by the way, we have big initiatives to build what is called, generally referred to as deposit tokens, right? So there will be infrastructure built, and currently the legal ramifications are set in the industry for deposit tokens, which will also be a big innovation. And BlackRock is building on public infrastructure. Why are some of the largest institutions building on public infrastructure? Because of network effects, right? If you build something on a proprietary infrastructure, you need to convince a lot more people to participate, and potentially some of your biggest competitors to participate in this infrastructure with you in order to gain, the economies of scale. So it's clear that a very significant part of the infrastructure will be run on public and open source networks, because otherwise you don't get enough institutions to participate.
Mm-hmm. Yes, I see. And there you don't sort of see an inherent discrepancy or maybe a problem between sort of the openness, and then also sort of if we're talking BlackRocks and other like institutional players, they have to adhere to all types of regulation, and maybe that's sometimes also a challenge that I've seen and that I heard other people talk about. If you want to go and move into an open source sort of public environment, it just sort of clashes here and there with regulation. Do you think maybe this can be solved, is being solved, or is there sort of an inherent problem that could also never be solved? So that's sort of question I have as well.
Good question. So look, I mean, the question is, the fundamental question you're asking is, who do we trust? Now, for some of you here on the podcast, you may know about the curve wars, right? So the curve, to me, it's a good example to really think about how decentralized and how well disclosed are certain aspects of what maxis here would describe as DeFi, right? Decentralized finance versus traditional finance, TradFi, these terms that we use. And when you look under the hood, many of these DeFi protocols, are very centralized, completely centralized. The decision-making process is very, very obscure, etc. So, and on the other hand, most marketplaces in the world are owned by the participant to the marketplace and are truly decentralized. Deutsche Börse is owned by all its members. Seats is owned by all its members. I mean, that's quite decentralized, right? So I think it's dangerous to argue, these are the good guys and these are the bad guys, because, it's supposedly the good guys haven't figured out yet to be really good all the time, on a machine basis, right? Enforced by smart contracts. So I think that's my general comment on that. And now more specifically between public and private and regulation. Look, the large institutions will figure it out. They work with the regulators. I think that's fine as long as there is a technology approach that brings significant benefits. That's great. And in the end, maybe some of the people that are more financially inclined to listen to this here, in the end, it's about capital efficiency, right? Tokenization is about capital efficiency. I can prove that I have something that is possibly worth something, which is in the eye of the beholder, but then I can collateralize that, and that is getting me access to capital more efficiently. That's what this is about. And when we move away, maybe one aspect we didn't talk about before, but when we move away from the developed world, right? It's not it's relevant, of course, but it's in the end, it's not relevant. It's more relevant what happens in developing economies. Because these developing economies, they have no credit markets, right? They have very infant credit markets. And the world runs on credit, right? The world runs on credit. So we need to solve this credit problem in emerging economies and developing economies. And what better way than to have a purely digital system where we can lend and borrow money against, right? And that is the beauty of the system, right? So we have to think this much larger. So when you think about tokenization and shared ledgers and immutable databases, it will allow us, to make loans if we desire to make loans for working capital, in developing economies, right? Some food vendor at the street corner in Dakar will be able to raise money from people like us in the future because we can see everything digitally, right? This should be the possibility. By the way, it's the same problem for SMEs, for small and medium-sized companies in Switzerland, right? And other economies in developed economies. Some of these companies that produce cash flows cannot borrow. They cannot go to a bank because they're not creditworthy, right? So
yeah, exactly. Yeah, that sort of makes sense as well. And I think, in terms of capital efficiency, what you say, I think, yeah, because things are maybe moving at crypto speed, as some people say, you do have probably a lot faster settlement cycles as well. That comes with the benefit of maybe not having to sort of hedge settlement risks and stuff like this, and then also across borders, as you said, maybe because everything is that more transparent and also faster. Obviously, it opens up new opportunities, and as you say, it's more capital efficient, and that's why it's also less cost intensive, and these business models only are developing because of this. So that's probably also a point that we have to sort of point out, right? Just because everything is faster. Yeah,
it's I think the distinction here is somebody recently told me in when I was traveling in London, I had a conversation. Somebody said, you need a Merkle tree, but you don't always need a blockchain, right? And that is I think that's great. That really captures that captures. So the idea here is that you need provability, that you need cryptographically secure systems. You need a Merkle tree, but you don't necessarily need a blockchain. That's true maybe for the developed world where we have a lot of institutions. That may not be true for the developing, economies where there's not a lot of trustworthy institutions. There we do need the blockchain, right? And Bitcoin is the case, right? When you go to Turkey or to other countries, right? I mean, Bitcoin is a store of value to hedge against inflation. That's great, and that if you hold Swiss francs, maybe that's not such a concern for you, unless you have certain outlook on the world. But that's important. I think one aspect we should revisit briefly on this tokenization. People always say that it solves for liquidity. It gives you more more liquidity in the market. I think that is not true, because liquidity is very complex. Certainly for financial assets, liquidity is very complex, and you need to understand what kind of cash flows are produced by the underlying asset, etc. When you talk about financial assets. So that is not solving for liquidity at all, because you need to understand the financial asset which underlies the item. And also I would argue, and some people here who've probably tried to build systems, they can they would agree with this. It also introduces risk, right? So now you're doing something that has been done in more established ways and clearly established ways, and now you're moving it to a new rail, as they call it in finance, right? It's a new rail. You're introducing risk, right? Is this blockchain really performing as you want? What are the validators' motivations on this blockchain, on this public infrastructure? How can I trust that this will always run, etc.? Those are really serious concerns, because we do not want to have things stuck on chain, right? Is it really the thing? Is this token really the thing that it says it is? Those are risks that are introduced by this new infrastructure, which prevent things from happening fast.
Mm-hmm. Yes, that's a great point. Or like both of these points are great in terms of risk. That this sort of introduces a new, new types of risk after all, and also in terms of the liquidity that you mentioned. That's a great point as well. I mean, people usually hear tokenization, makes things more liquid, but it's not actually true. It makes it maybe more technologically more easily transferable, but that doesn't mean that there's like sort of a economic liquidity aspect attached to it automatically. And that's why I've been always sort of skeptical of these moves to tokenize like SME shares, and startup shares and stuff. It all sounds so great in theory, but then there might not be an economic aspect after all, or like a sort of economic underlying, that this is really what people want, and because the liquidity is lacking, and needs to,
so that's one. So SME shares is a good example, right? Which I think is, it's great. I also bought shares that I love. That it's more of a love. You buy a share of a small and medium-sized company because you like what they're doing. How can you be sure what they're telling you that they're doing? And cash flow you can look at maybe, but what is the position in the market? It's very difficult to understand. And the other thing is real estate, right? I think we also should put that to bed. Tokenizing real estate does not make it more liquid. It just doesn't, right? How can I judge whether this house in Sao Paulo or at this street corner is really a good investment or not? I can't. How can I know that? I need to know so many things before I can justifiably make that investment. And provable well, of course, it's based on cash flows. If I can see the cash flows and I believe the systems that these cash flows are produced in, and I believe I cannot be defrauded, then it's a great system. Sure, if I can buy a small share and diversify my portfolio in real estate holdings with cash flow producing assets across the world, amazing, right? But there's so many things that need to be put in place before I can do that. It just, it's, I don't understand how it is that this should actually provide more liquidity.
Yes, good point. Good point. Well, I mean, I want to come back to this one thing that you mentioned, deposit token. That's a word that stuck with me now and during the interview. And I want to sort of, the cash lag that you mentioned, in terms of stable coins. I think they play an important part. I think there's also pretty broad and wide understanding, and also, people are agreement, that there's some use case there as well, and it's developing. So maybe can you say something about this, and then also what is a deposit token and how is it different from a stable coin, and specifically when it comes to Switzerland, what are we doing there, or where are we going there?
Yeah. All right. So I'm not not familiar with all the details of what is currently being discussed in Switzerland, but of course the idea of a deposit token, I think, is easily illustrated with JP Morgan coin, right? The JP Morgan coin is basically representing your deposit. So company A, has 100 million in the bank. Company B has, 50 million in the bank, and they owe each other. Company B owes 15, or company A owes 15 million to the other company. So they pay. They pay. Normally they would do that with cash, right? They would send US dollars, maybe real at some point, in the process. And now here, those assets and as well as the obligations would be represented in deposit tokens, and then you can net out, right? So, and of course, between banks, that will be very interesting. So I'm not sure how this will look in Switzerland in the end, but it's also important that the deposit token is not real cash, right? It's the obligation of the bank to give you money, right? So to give you cash. So you will hold, so I mean, you're already holding deposit tokens, if you ask me, because when you look at your bank account, the money is not really there. The money is there in a database that says, we owe you, Mr. Client or Mrs. Client, 55,000 Swiss francs or euros or US dollars, right? So it's not really there. It's just the obligation of the bank to give it to you.
Yes, exactly. It's an obligation. It's sort of a representation of the balance sheet that they have, the liabilities on the balance sheet, that sort of, you can, claim, but it's also different from stable coins then.
Exactly.
Because it's only internally.
I mean, stable coins are great, right? Stable coins are fantastic. It's a problem that Switzerland is so hesitant in terms of stable coins because, the Swiss franc has a lot of use in the world, and so it's difficult to see why it wouldn't make sense to have Swiss franc based stable coin. And the exciting thing here is, when you think about it, I was just traveling for a few days in a developing country, and I met someone who's trading in that country, and I asked, what kind of cryptocurrencies do your clients and your vendors want? And he said, and I said, what do they have a preference between USDC and USDT? And they wanted USDT, right? So, and he doesn't want to do it yet. That's it. Also interesting. I was like, why would you want to do it? And he's like, but I'm not set up, and it's a problem with the bank, in in the Western country that I'm basing my business in, and so on. So it's really interesting. So stablecoins are really powerful, but I'd like to make sure that we understand. I think the stablecoins are not the end, right? The end, as I said before, the economies and the world runs on credit. And we need to solve the credit problem. And stablecoins help solving some of these issues. But, credit markets are much, much larger than cash markets. I know, well, we always talk about, this huge payment and all these cross-border payment problems and remittances. That's true. But, you have to imagine in some countries, in some developing countries, the only tradable debt is the government debt. So you cannot securitize anything else but the government's debt, if at all. That's terrible. That we need to find a way to to have natively digital credit obligations that can live as objects, in these new rails, which then can be securitized and really brought and bring liquidity to these markets. Right, that's the key. That is the key.
Yes, and I have a feeling some of these countries are already looking at this, because that was always my feeling when El Salvador announced the Bitcoin announcement, and then they went further, with this Digital Asset Securities Act, I think, and then they were also looking at sort of how to tokenize things, together with Blockstream from like Adam Back, and I think they have other people that they're involved with, maybe Tether now that moved to El Salvador, They have this platform called Hadron, I think, where they do sort of real world tokenization on. And I think maybe it will be up to these players, like a player like Tether, that's going there offering some sort of infrastructure for these countries to sort of develop their credit markets and have like some other things besides government bonds that will be tradable. And maybe, I don't know if you have any thoughts there, but I think that could be the way. And I think we're seeing it play out, although slowly we're seeing it sort of move along.
Yeah, I think
already.
Yeah, I think we have. There's two aspects to this when I look at the world. Right, one is there is the desire of these places, of these developing economies, to find better ways, for their financial systems, and the shared ledger is extremely powerful. An immutable shared ledger is even more powerful, which is what Bitcoin shows us, right? And you can create trust immediately. All economic activity is based on trust. So, the more trust you can generate with technology, the less costly an economic system will become overall. So that is, or less costly to doing business, in an economic system. So that's the promise of the technology. This is why we have to be excited, whether you're a maxi or not. But this is the reason why you have to be excited about this technology. So that's one. So we have these economic underserved systems that would like to find a better way. And then on the other hand, I'm thinking about the big game, I would call it. Right, the big game is who will dominate this new infrastructure in the future. Right? Because make no mistake, currently people think about how to build the infrastructure in a way that they can participate and that they can still dominate, right? And certainly the United States thinks about that, clearly understood now that that de-dollarization is a danger for them. So now they have to make sure that it doesn't happen, and they have to build better systems. And then there's the donor countries where the capital is coming from in the future. And I always think that if I was the ruler in the UAE, or if I was the ruler in Saudi Arabia, I would really hate to continue paying thousands of dollars per hour for some stupid law firm or stupid lawyer, or not stupid. They're not stupid, but let me rephrase. So, for processes that are well established, that should cost a lot less, in New York or in London or in Frankfurt, I mean, if I was a capital provider, I would be trying to build an alternative system, which is what they're doing, right? They are thinking about it, and they see tokenization, and they see blockchains as a possibility to build an alternative system outside of the current rails, which give them more control over what is going to happen in capital markets. And I think that's the big game, which is why it is important for Switzerland now, since I'm here and I'm Swiss, it's important for Switzerland to think deeply about these problems as well, and start building and also push innovation from top down, from the government. The banks are not going to do it, right? In Switzerland, banks have no incentive to be more efficient, more competitive, etc. I mean, in Switzerland, they have such big margins, So this needs to be pushed also from top down, and it needs to be pushed from bottom up, from people like yourself and ourselves and other innovators, which say, hey, currently here, the global cards are being reshuffled, and it's about the big game. Either we build infrastructure and we participate in this infrastructure, and we're going to be a meaningful player in the future, or we're not.
Yeah, I see. That's an interesting topic as well. Maybe some topic for another day, but I also have like a slight feeling that Switzerland is maybe falling behind here a little bit, and we maybe need somebody to give us a wake up call. But maybe that's a topic for another discussion. Ralf, I think I want to say thanks. That was interesting, talking with you about the entire topic of tokenization and how it relates to what's really going on. So is there any final thing you want to add that hasn't been said yet?
I think we've covered most of the relevant topics, right? So
nice. I think so too. Then maybe just my last question is that I ask to every guest: is there any other high signal person that we should bring on the podcast, and then maybe that we can sort of learn from them also in terms of when it comes to capital markets, tokenization, or maybe something else altogether?
And I realize there's two people that come to mind, right? In Switzerland, I would say I really like Katie Richards' perspective. She's she has spent many decades in capital markets infrastructure and front end and back end and so on. So her take is very unique. And the other person, I think not in Switzerland, but that thinks deeply about the space, his name is Nitin Gaur, which is quite well known, right? He was at State Street for a while before at IBM and built performance systems and infrastructure. And now he's really trying to build infrastructure, to connect to these new rails for traditional banks. So those are the two people that come to mind.
Great, cool. Yeah, that's certainly some good names, and we'll check them out. So thanks a lot for mentioning them to us. And I think without further ado, I would say let's call it the quits. And then thanks again for coming on, and hope to see you again in the real life for sure soon. Thank you. Bye, Ralf.
Thanks, bye-bye.